You are listening to The Vocal Technologist. Spoken Tech for your ears.
Welcome back, everyone. It is Web3 Wednesday, and today we're looking at what the builders are actually building, beyond all the hype.
Exactly. It feels like a hectic moment, but in a good way.
Yeah, like regulatory clarity is finally starting to meet actual institutional demand. But what's really interesting is the stuff happening underneath all that, these almost sociological shifts.
It's a real convergence point. And we've looked at a bunch of material that tells a story that's, well, it's a lot richer than just speculation.
Okay, so what are we tracking for them?
So we're looking at three main forces. First, the deep socioeconomic engine that's, driving all this participation.
So why?
The why. Then, the institutional scaffolding that's being built, especially in Asia. And finally, some of the really cutting-edge tech that's needed to make this whole thing scale globally.
Got it. So we're going to pull those threads together and give you the full context.
Yeah, so you can really understand the pace of change right now.
Okay, let's start there with the why. This is maybe the most surprising part. We always hear that people are in these markets because of greed or, financial illiteracy.
Right.
But the research we have completely reframes that. It talks about something called the prison of financial mediocrity.
That phrase is such a game changer.
Isn't it?
Because it shifts the whole conversation. It's not about a moral judgment anymore. It's about rational economic adaptation.
Okay, so what does that mean in practice?
It means if you look at the structural problems in the legacy system, especially for younger generations, their path to prosperity, the old one, it's gone.
So give us the hard numbers on that. What does that broken ladder actually look like?
It all starts with this massive generational wealth gap. Baby boomers still control about half of all the wealth in the U.S.
Half?
Half. And millennials, they hold about 10%.
Wow.
So now you stack that against what's been happening recently. Okay, so wages went up, 8% in a recent cycle, which sounds okay.
Yeah, not bad.
But in that same period, housing costs doubled in a lot of big cities.
Yeah.
Doubled. And youth debt payments. So think student loans, credit cards, shot up by 33%.
So even if you're making a bit more money, you're falling behind faster than ever.
Exactly. The old social contract is just, it's void. The path of, save slowly, invest in your 401k, it doesn't get you anywhere anymore.
It just guarantees you stay stuck.
Right. So when that's your reality, these high variance markets, they stop being just a gamble. They become the only perceived way to get some financial agency, a moonshot chance to break out of that trap.
So the behavior we see in crypto or even in sports betting, it's not reckless.
It's a rational strategy, even if it feels desperate. It's a response to just overwhelming structural odds.
And that structural pressure, that demand, it isn't going away.
No, it's the fuel. It means all these systems we're about to talk about, they aren't niche. They're a necessary response to the world we live in now.
Perfect. Okay, so if that's the why, let's get to the how. How are people trying to get an edge in these markets? This brings us to a really cool concept, cognitive finance.
Cognitive finance is, it's one of the most exciting things I've seen in a while. It's like a genuinely new way of knowing things, of forecasting.
So what is it?
It's a synthesis. It's taking two huge forces and putting them together. You have large language models, which they encode everything about the past from their training data.
And you pair that with prediction markets.
Exactly. Which are all about aggregating what people believe about the future.
So you're combining historical intelligence with, incentivized foresight.
That's the perfect way to put it. An LLM is, by its nature, backward-looking. A prediction market is forward-looking. Put them together, and you get this forecasting system that's proving to be incredibly accurate and fast.
And we saw just how fast late last year. There was this amazing detail that in November 2024, prediction markets called a major election result.
Yeah.
One candidate was priced at a 60% probability in the market, while all the traditional polls were still calling it a complete toss-up.
And that raises the big question, why? Why are they so much better?
Right.
And the answer is pretty simple. It's the cost of confidence. On a platform like X, being loud and confident is free. It gets you likes.
In a prediction market, you have to put your money where your mouth is.
You have to commit capital. If you're wrong, you lose money. It's that simple. It forces accountability.
Skin in the game. It means reality settles the argument, not an algorithm.
And the scale here is getting huge. Kalshi and Polymarket were the big players in 2025. Their combined volume was in the tens of billions.
And it wasn't just politics, right?
No. Surprisingly, the biggest driver for that growth was actually sports betting.
That makes a lot of sense, actually. Sports betting gives you these high-frequency events to train people on the mechanics.
Exactly. And because of that growth, you're seeing them move from the crypto fringe into the absolute mainstream. Companies like Gemini, even betting giants like DraftKings, are trying to get in on it.
That's a huge embrace of a decentralized idea. Okay, let's pivot from the tools to the rails carrying all this capital. We have to talk about institutional adoption and this global push for stablecoins.
Stablecoins are the foundation. You can't have a digital economy without digital dollars or digital yen or digital won. And the really critical stuff here is happening in Asia. 2025 was the year of Asian regulatory clarity.
Okay, what happened specifically?
Well, Japan moved forward and successfully launched a legally recognized yen-pegged stablecoin, a digital yen. And this wasn't some small thing. It had pilot programs with major Japanese megabanks
So a serious move toward using these for real settlement.
for domestic settlement
Mhm.
and maybe even cross-border trade.
And South Korea was on a similar path.
Precisely. Multiple one-peg projects launched, all while the government was scrambling to get a formal regulatory framework in place. It just confirms the whole idea. You need local currency stablecoins to connect your economy to the global on-chain world.
And this momentum is why we're seeing these massive growth predictions.
It is. Coinbase Institutional put out a forecast saying the global stablecoin market cap could hit $1.2 trillion by the end of 2028.
$1 trillion. Wow.
It's a huge bet that these rails are going to be used everywhere.
Speaking of institutional access, we saw a ton of crypto ETFs launch in the West.
Dozens. Solana ETFs, Polygon ETFs, you name it. But the capital, it concentrated pretty quickly. Bitcoin and Ether ETFs still got the vast majority of the inflows.
And that flow of capital is only getting faster.
Absolutely. The SEC has been streamlining its listing standards. The approval time for a new crypto ETF has gone from over 200 days down to around 75.
So more are coming, but the market's going to decide very quickly who the winners are.
It's institutional Darwinism, really.
Let's talk about the vehicles themselves then. Digital asset treasuries, or DATs. They were a huge deal in 2025, but they've already changed.
Yeah. They went through a big consolidation. The first model was just, simple buy and hold.
Not enough of an edge.
Right. So the new version, D 2.0, is much more sophisticated. It's moving to specialized strategies, not just secure storage, but the procurement of sovereign block space.
Okay, procurement of sovereign block space. That sounds incredibly strategic. What does that actually mean?
It means they're starting to see the blockchain itself as a vital commodity, not just a place to hold assets. Procuring block space is about buying the right to get your transactions processed quickly and reliably.
So it's a defensive move.
It's a defensive move. It guarantees your transaction priority, and critically, it lets these huge players shield themselves from MEV, from front-running.
Wait, okay, but if these big institutional players are strategically buying up the utility layer, doesn't that introduce a huge centralization risk?
That is the central tension of this whole wave of adoption.
Yeah.
They're using the technology, but they're prioritizing their own security and efficiency over, pure permissionlessness. The big challenge for the ecosystem is making sure a few powerful players don't end up gatekeeping the whole system.
That's a really important check. So that foundation stablecoins and these strategic treasuries is paving the way for everything else. You mentioned on-chain spot equities.
Yes. Once the digital dollars are on-chain, people naturally want everything else there too. It just gets rid of the friction of moving on and off-chain.
And what's the real unlock there? Is it just trading 24/7?
That's part of it. But the real unlock is bypassing the traditional brokerage gatekeepers. Think about permissionless securities lending. Right now, you have to go through a broker to borrow against your stocks.
On-chain, you could do that programmatically.
Instantly. And far more of the yield goes back to you, not the middleman.
Okay, let's pivot to the deep tech. What's on the absolute cutting edge that's solving some of the biggest problems?
Well, the core problem in any distributed system is state machine replication, or SMR. It's how everyone agrees on the order of transactions.
And all the current systems have trade-offs. Speed versus security versus decentralization.
Exactly. And that's what's so interesting about the Alpenglow consensus protocol. It's a new SMR approach designed specifically to improve those trade-offs. It's targeting better throughput, lower latency,
So faster confirmations.
faster confirmations, and stronger finality. And the innovation, which is what the vocal technologist audience will care about, is how it uses a delegated consensus system with this really rapid randomized leader selection. It makes it faster without sacrificing security.
That's efficiency. But what about the other big headwind, the concerns around privacy, MEV, and just surveillance?
Those are huge issues. MEV, maximal abstractable value, is basically a hidden tax on every single user. It's what validators can make by reordering transactions in a block.
So we need a way to stop that transparency from being abused.
And that's where something like the Shade Network comes in. It's a direct, really uncompromising response. It's a fully private layer 2 that just encrypts everything by default.
So it's not optional privacy you have to turn on?
No, it is the foundation. All transactions, all smart contracts, all agent actions are encrypted from the start. It's designed to give you Monero-level privacy, but with Ethereum's programmability.
How does it do that?
It uses encrypted mempools, so no one can front-run you, stealth addresses, and zero-knowledge verified settlement.
Okay, that last zero-knowledge verified settlement is key. Break that down for us.
It means the network can cryptographically prove that a transaction was valid, that it followed all the rules, without ever revealing the sender, the receiver, the amount, any of the actual data.
So you get verifiable correctness with total privacy.
Exactly. It makes privacy the default, which
Right.
attacks the MEV problem right at its root.
Encrypted by default. That's a huge philosophical shift.
Yep.
Okay, so we have the tech, we have the institutional rails. Let's talk strategy. How are the big layer 2s positioning themselves? Let's use Base as a case study.
Base is a perfect example of an ecosystem at a crossroads. We saw this fascinating open letter to Base execs,
Right.
and it argues that they need to pivot. Right now, their strategy is really overweight on the creator economy. Meme coins, social apps.
And the letter says that's too narrow.
Correct. It's fun, but it's not enough to survive long term. The argument is that Base needs to position itself as a comprehensive on-chain economy, a real financial alternative.
So moving from attracting users to attracting GDP.
Precisely. And that ties right into this huge debate happening everywhere, tokens versus equity.
Where does the value go?
It's totally unsettled.
Yeah.
A lot of the big projects came up in, let's call it the Gensler era, where all the regulatory pressure forced them to drive value to equity. The token was just for utility or governance to reduce legal risk.
But now the policy environment is changing.
Now the pressure is easing. So projects have to fundamentally rethink their token economics. They have a chance for tokens to become a powerful capital formation tool again. But if they make the wrong choice now, they could get left behind.
Quick check on another piece of infrastructure, vaults. They used to be pretty simple yield tools. How are they evolving?
They're transforming. They're becoming strategic coordination infrastructure, moving way beyond just yield farming into complex treasury management, almost like on-chain VCs focused on specific ecosystem goals.
So capital is organizing itself much more strategically inside these systems.
Aggressively, yeah.
Wow. We've covered a huge amount of ground today. From the societal pressures forcing this change, this rational desperation for a way out,
Yeah.
to the birth of cognitive finance, the trillion-dollar stablecoin pipeline, and all this new privacy tech and strategy.
We've mapped the whole landscape, really, from the user's emotional core all the way to the institutional scaffolding.
So what's the big takeaway, the final thought for people to carry forward?
Well, if the flow of wealth and this pressure for agency keep favoring these decentralized systems, consider this. It's a long-term thesis, but
Go on.
that Ethereum, specifically ETH, is positioning itself to become the reserve currency of the largest future global economy, an on-chain, AI-driven economy.
ETH as the reserve currency for an economy built on smart contracts.
So what does that prediction imply for our traditional ideas about monetary stability and national sovereignty?
Yeah.
If global trade starts to rely on a decentralized programmatic currency instead of one backed by a single country, what happens to geopolitical power?
That is the macro shift we're watching unfold.
It's happening in real time.
Yeah.
And it's something you should definitely be thinking about as you watch all of this develop.
Spoken Tech for your ears.